Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table.
Well, welcome to Integrated Insights. Today I've got Andrew and Grant with us, and we're going to be talking about private equity.
Right.
Yeah. So guys, can you start by explaining what private equity is and how it differs from other types of investors?
Yeah, I mean, private equity is simple because it's just people buying a business that is privately held and not, as opposed to investing in the stock market, which is typically public securities, right? And so it's a private business. But the term is typically used for a business or a group of investors that are partnering with a sponsor that is going out and buying businesses of a certain kind. And we'll talk about strategy in just a minute, but they're charged to go out and invest in business, maybe leverage it, maybe not, and grow those businesses' value and then sell those businesses. So it's private business ownership really is what it is.
And I'll say as well that private equity groups are set up differently, and there's several ways to structure them, but some will build up a fund that they'll use to go out and buy and do some sort of mixture of their of equity and debt to go buy. Some will need to raise capital based on the deal, and so if they find a deal and an offer is accepted, then they'll need to go and find the equity to go support what they're trying to do, the purchase. And so there are different types of private equity groups, and but there are a lot of them out there, and they're structured differently.
Yeah, at the risk of blowing through our time, let me get on my soapbox for just a minute. You have this sort of flavor of the day coming out of MBA school. You know, they come out of these graduate business schools and they've learned all about, these funds. Okay, we're going to go and find a business, and we're going to buy a business, and we're going to raise money to buy the business, and we're going to get into private equity. And then you have on the other end of the spectrum some really sophisticated firms that have a ton of infrastructure that they're experienced, and they know how to do the purchase and management of those businesses, whether they're hands-on or whether they are remote investors. They've got it down. And so to think that private equity equals private equity is really wrong, because there's tons of different kinds of firms that call themselves private equity. We never called ourselves private equity, even though we owned a bunch of businesses at the time. And so there were other people maybe called us a private equity firm, but we've never called ourselves a private equity firm. We were just some dudes who owned some businesses.
Yeah, there are many, we call them investment vehicles, right? And so there's private equity, venture capital, holding companies. It's essentially an entity that owns another one, and their investment, the way that they get investment is kind of what really determines what they are, essentially. And so I know that there are other ways to determine what they are, but that's a big part of it. And so for private equity, they have they may have a handful or a lot of investment that they have gotten from institutions or individuals or whatever that looks like. I know family offices as well is another investor for private equity groups, and they'll get that and either build a fund or they'll just find a deal to to go buy. And so that's what a private equity group really is. And I mean, I know there are many other aspects to them, but on a 30,000-foot view, that would be what it is.
So what strategies do private equity groups use when evaluating a potential deal?
Yeah, that is based on many things. A lot of people will make their criteria, right? They'll build out the geographic criteria, financial criteria, and maybe even industry criteria. A lot of that is based on where they're getting their funding from. A lot of private equity groups will get funding from an institutional fund that has certain mandate, right? And maybe they say, hey, we're only going to invest in this type of company, right? So industry wise, and so maybe that's what it is. But it could also be based on the experience that those individuals that are part of the private equity firm, what they have, right? A lot of people that we talk to, they'll do what they call business services or what we call field services, right? There's facility services. It's all that commercial services. Some do home services. Some do healthcare. Some do industrial type of businesses. And it's all part of they build this criteria so that they can go after similar type companies and do a similar play over and over again. And so at the end of the day, for what we see, it is most of the time it's about their exit. That's what they have in mind when they're buying a company. Their strategy is really about how they're exiting. And so you could have long-term and short-term, but they're looking at, okay, how can we build it up to exit? And maybe in 5 years or in 20 years. Most will be on the shorter end of that. But really, that's kind of what they build their strategy on, is they will buy how they know how they're going to exit, in that time frame. And so that's kind of what we see, what I see as a lot of how they build out strategies in their firm.
Yeah, I would just add, it's the golden rule. He who has the gold makes the rules. And so the private equity firm typically is a sponsor, and they have limited partners or investors, however they're structured. And those investors buy into an investment thesis. And so, hey, I'm going to go out and I'm going to buy 20 plumbing companies across the United States. They're going to be service oriented, not construction. They're going to be, anywhere from $1 million to $5 million of EBITDA. The way I'm going to price it is going to be a maximum of, 5 times EBITDA. And I'm going to borrow a maximum of 2.5 times EBITDA. And there's all kinds of different types of the limited partners will put on them, particularly if the sponsor is inexperienced or not as experienced as some of the big funds that are out there. Some of them are just general, and they say, "Hey, we're going after healthcare services," it all depends on the people that have the money.
Mm-hmm. Yeah, and there's always a bigger fish, right? And so where we hang out a lot is in that small to middle market size business. The multiple and really in the smallest end that we work on, it's there are a certain level of private equity groups, right? And what I mean by that is that they focus on that size and they want to roll up, and their thought is, okay, I'm going to buy these companies that have maybe 2 million in EBITDA, right? And the multiple range for that size is I'll just say numbers, 4 times, right? And then they group them together, and if you have 5 of those companies that have 2 million in EBITDA, now you have 10 million in EBITDA. And if you've put them together, and so once it goes over that 10 million mark, the multiple goes up, and there are certain levels. And so when they do that, then they can turn around and sell it to the bigger fish, and then they turn around to the bigger fish, and it just goes up and up and up. And that's how a private equity group will, most of the time, that's how they'll make money, is they'll I say flip, right? But essentially they're buying so that they can sell at a greater multiple later on and build value that way. And so that's the most basic strategy that we've seen.
Yeah, that's great. So how do private equity groups affect the M&A market, but also the lower middle market as we're in?
The most fun that we have is that there's a lot of people who want to call themselves PE groups, and they don't get paid unless they invest capital. And so our business owners, if they have a successful business, it's very difficult to find one person to buy the business. There's not a whole lot of people who can stroke a check for $15, $20 million. And, but these private equity groups are, essentially end up being investors that can borrow some of that, invest some of that, and it provides just a much bigger market for people to buy businesses. So this is the basis of a stock market. For example, I have no way to buy IBM. Just think of it or Apple, right? I can't buy Apple. It's just jillions, right? And I don't have jillions, and there's only really a handful of people who have jillions enough to buy Apple. But we all can own a piece of Apple, right? Now that's a public market. So there's not a whole lot of individuals that can write a check for $15 million to buy a very profitable private business. So they invest with others in a private equity scenario where they can be a business owner. And they may not run the business on a daily basis, but it allows so many more people to actually own private businesses, which I think is a cool thing. So it expands the buyer base, right? How they do affect it is kind of weird, because Andrew will laugh when I say this, but there are flavors of the day. We'll go out there and we will meet with PE groups, and all of a sudden they all want manufacturing companies. I don't know where they get this from, but maybe it's publications or something like that. And then all of a sudden oh no, we don't want transportation and logistics. No, we don't want that. And then 6 months later, oh, hey, we don't want any healthcare, but give us all the transportation and logistics. It just kind of the flavor of the day. And I'm bent on finding the publication that they all read, because it's got to be out there, right? And so, yeah, I don't know. Yeah, but I think what really drives that is they have to have an exit at some point. So they're looking at what companies may exit well, and if those guys are looking for let's say, field services like plumbing, for example, or HVAC, they'll go out and roll them up and sell it to them. That's how they're going to do it. And so it does affect it, because sometimes we're looking at a company trying to help our clients sell, and we're saying, hey, they're wanting manufacturing companies right now. They're wanting fabrication and machining and manufacturing, especially in the defense and aerospace industry. We know that, but it wasn't always like that 4 years ago, we couldn't give a company away that was steeped in that. And so now all of a sudden everybody wants it. And so you also got to be careful, because maybe in 2 years' time, nobody wants it again. And now you've got to hang on to it until it has value again. So PE groups, because they are so powerful in increasing the buyer base, you need to watch how they influence the flavor of the day.
Yeah, we always say kind of call it a buyer universe, right? So the sheer amount of buyers that affects the value, right? The multiple. If there are a ton of buyers, the multiple will go up. If there are a very very narrow a very narrow buyer network, buyer universe, if you call that, then the multiple will go down. And so the way that it affects it is that if private equity groups are super focused on that one industry or that type of business, then the multiple might go up because of that, because there are way more buyers. And so that's where it's unique in the way that they do affect the M&A market. Most of the time, I know that there are different strategies to valuating a company when it comes to private equity versus a strategic. And so a strategic buyer, meaning another buyer that there's a strategic purpose that maybe it's a competitor or another adjacent service that they're wanting to add this service into their repertoire, right? And so it really it's unique in the way that they come into the market, and they affect it by honestly, private equity groups most of the time might pay a little bit more. Now you probably will. The structure is going to be very different, but you might get a little bit more. And so it just depends on the industry and kind of the timing as well, right?
While we're up, the biggest difference between a strategic buyer and a financial buyer or a P group is a strategic buyer is interested in the parts of your business. The P group is interested in your cash flow. And so that's why, in a previous podcast, we talked about due diligence. That's why a strategic buyer is going to be focused on the parts of your business and your capital expenditures that you've made in the past, not just what you need in the future. They want to see what your capacity is, because they want to throw some capacity your way. All those kinds of things. The P group just wants to know how much money they're going to make. We joke about the motives of a PE group. They're pure. I mean, it's all about the bottom line. And I know I'm going to be,
I'm going to get like 20 emails for this.
Yeah. I mean, there's we're around people that talk about redemptive investing and, investing that is going to help the community and all that kind of stuff. But at the end of the day, a PE group doesn't exist without a profit motive. And the way they make profit is based on the cash flow of the business. And so that's a big difference between a strategic buyer and a PE group.
Well, that's all we got today. Grant, Andrew, thank you for your time. And thanks, everyone, for listening.
And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.